Basie, and today I'm going to be speaking about taxes and the effect that they have on privately held companies. You've got to understand in the United States we have a lot of tax incentives for privately held companies. And if privately held companies aren't aware of them, they should be, because it makes a major difference on the profitability of an operation. Obviously, in a privately held company, the accounting and the taxes are different than a publicly held company. A publicly held company wants to increase their profits that they report to the general public so that their shares of stock on the stock markets can go up in value. That's what we refer to as a price-earnings ratio. Just because a company shows a higher profit does not mean it affects their cash. Okay? Also, just because a company doesn't show a profit doesn't mean it negatively affects their cash. I'll give you two quick examples. In the United States, we have an accounting concept called LIFO. That means last in, first out inventory. Many businesses make use of this. It has no effect whatsoever on cost as far as the cost of inventory is concerned or the money paid for inventory, and it has no effect on the products that you're actually selling. What it does do, it allows a company to take a replacement cost of an inventory item that they've sold and show that as if that's what they sold. Let me give you a quick illustration. Let's assume in January a company pays $500 for a product, turns around and sells it in March for $700. So in April, they rebuy that product. Now remember, they bought it for $500, they sold it for $700, so they've got, from your and my standard, they've got $200 in profit. But they replaced that product in April by paying $700. If they use a LIFO inventory method, they are allowed to take the $700 replacement cost of the new inventory that they haven't sold and deduct that as if that's the cost of the inventory that they did sell in March. That means if they sold the inventory for $700 and it cost them $700 to replace it, they show no profit and therefore pay no taxes and therefore increase their cash flow. Now, I will warn you, Congress has a proposal right now, as I'm speaking, that could make LIFO illegal. However, I would recommend everyone that carries inventory to talk to their accountants to consider the LIFO method of inventory. Let me give you another item that we have a big concept in the United States, and that is bad debts. Unfortunately, some companies have bad debts, and we try not to have them. Are you aware that it is illegal for all businesses in the United States on their tax returns to estimate their bad debts? They can only deduct them when they occur. But there's an exception. Financial institutions, and you've heard a lot in the newspapers about financial institutions, are allowed to estimate their bad debts and deduct their debts before they occur. So please be careful of this. Talk to your accountants about the method of accounts receivable and methods of writing off your bad debts for tax purposes. Big difference between accounting and taxes. I hope I've been of some help to you today. Thanks very much for your time.
To view more quick clips, visit ISSA.com.